Hello and welcome to CIO Perspectives. I'm Sid All, the Co-CIO for Private Clients, Endowments and Foundations here at Brown Advisory, and I'm joined today by my Co-CIO, Erika Pagel. We're excited to have with us today Ryan Myerberg, a partner and portfolio manager here at Brown Advisory, helping lead our global fixed income team. Prior to joining us, he was the head and CIO of absolute return fixed income at Amundi, and prior to that, spent 9 years at Janus Henderson, launching their global fixed income platform. Before Janus, he spent time at Blue Mountain Capital, Morgan Stanley, and Lehman Brothers. He's well-versed in all sectors of fixed income, and his team can take views on interest rates and currencies as well. So we're excited to have Ryan on to talk to us today at a time when bonds, rates, and currencies are so much a part of the investment story. Before we bring in Ryan, Erika, what's on your mind with respect to the markets at the moment?
Thanks, Sid. This continues to be a very complicated time. Despite a bunch of recent negative macro data points, equities continue to move higher despite elevated valuations. And we continue to have market volatility around tariff discussions. The Fed has shifted gears on its policy and has started to cut once again after a long pause. And there are re-emerging inflation pressures. So there seems to be more economic vulnerabilities today. And the markets continue to shrug off a lot of uncertainty as just near-term noise. We've been in a bull market now for 3 years. The market has rallied more than 30% since April lows. The recent quarter, we saw continued AI momentum, which drove U.S. large caps up more than 8%. But we did see some reversals, such as small cap, mostly on interest rate sensitivity and the Fed's first cut. But small caps did bounce off lows up about 12%. And then on the macro front, which I know we'll dive into today with Ryan, unemployment is ticking up, but is low by historical measures. However, hiring and participation rates are slowing, which is spooking the Fed. And there's also an impact from immigration. And a lot of economists think that the unemployment rate is actually much higher when you look at labor supply declines. And I know we'll cover this today. We are faced with a government shutdown. So one of the things that we will be watching is any permanent layoffs as time goes on. On the tariff side, we've just kicked off earnings season. We're looking forward to hearing more from companies. Just recall that earlier this year, a lot of companies front-end loaded their inventory levels. So it's not a surprise that tariffs have not shown up in the data. And I think a big topic today that we're hearing a lot from our managers as well as clients is the momentum as well as the risk around AI. There's a lot of fear of missing out, or FOMO. Gartner expects over $1.5 trillion in spending this year, which is unprecedented. There's been landmark deals and partnerships that have been announced recently. And this has pushed S&P multiples up to above historic multiples at 23 times. So what that means is there's a lot of good news already priced into the market. So can the rally continue? We can't answer that, but much of it does depend on earnings growth for mega caps as well as a broadening of overall earnings growth. But keep in mind, those beloved 7 stocks have accounted for more than 60% of earnings growth this year. So we'll be watching if that trend continues. But that concentration of the index has continued to be a headwind for a lot of our active managers so far this year from a performance standpoint. But for now, Sid, as tech and AI goes, so goes the market. So back to you, Sid. As I mentioned, there's just a lot riding on Fed cutting interest rates, tech earnings, AI investment. What's on your mind and how do you see this momentum continuing?
Well, I'm sure you've heard me talk about this a lot, and some of our listeners will have as well, but you hit it, AI. I'm still spending most of my time on that topic, and the growing AI infrastructure build-out, it's powering a large portion, maybe the majority of U.S. economic growth, while we're still seeing some kind of weakness in the industrial economy, housing, some signs of weakness in the labor market, which you pointed out. All that being said, it feels like the next 18 to 24 months of this AI infrastructure spend is going to grow significantly and appears pretty firm. So at the same time, we've got falling interest rates that has the potential to spur the housing market, sales, renovations, perhaps home building, and overall relieve some of the pressure on businesses and consumers that have high debt levels. So really high level, despite these elevated valuations in the market, I feel like the setup for risk assets is fairly solid. We've got reasonable growth, falling interest rates, and I would also note overall debt levels at the company and consumer level are still pretty low, and those interest rate burdens are going to be falling. What concerns me is what you mentioned, the overall reliance of the economy on AI, and at a time when this infrastructure build-out seems to be entering a riskier phase. So one where we're seeing more reliance on debt financing and increasing intercompany deals. So the hyperscalers were funding this mostly through free cash flow. with more limited debt usage 12 to 18 months ago. Now we're getting projects that are 80% debt financed and something like $100 billion of data center related debts outstanding. We've also got, you mentioned this circular financing thing going on, vendor financing, NVIDIA taking a stake in OpenAI and CoreWeave, OpenAI buying AMD chips, but also taking a 10% stake in the company, perhaps. These interrelationships with these companies are growing, the correlations are rising, and all this is happening at a time when the overall market importance is rising in public and private equity and credit markets. So to be clear, I would say I don't see this as a very near-term issue. The fundamentals of AI usage are off the charts right now, and supply is nowhere close to meeting demand. I also remind myself that the models we're using today will likely pale in comparison to the ones we're going to be using in 6 to 12 months, trained on new NVIDIA chips with larger clusters, new techniques. But at some point in the next few years, we're likely to be confronted with an issue of overbuilding. It's almost inevitable right now, given all the excitement and the competitive pressures. The last thing I'd say before bringing Ryan in is many of you who listen to other podcasts are probably aware of this book tour that Andrew Ross Sorkin is on at the moment, talking about his book of 1929 market crash and the Great Depression. I would just say this isn't 1929. In fact, I think we would say this still pales in comparison to some of the froth we saw in 1999. We're starting to see more froth, particularly in smaller companies related to areas like small modular reactors and drones, and retail participation in some very speculative stocks is definitely on the rise. But when we look at those bigger companies making up a big chunk of the index, they still appear somewhat reasonably valued with very strong fundamentals. So I try to take a breath when I hear and see all these headlines about Andrew Ross Sorkin and his 1929. But with that, let's bring in Ryan. Ryan, welcome back to the pod.
Yeah, great to be back. I was just thinking the last time I was on with you guys was June of 2022. So things have changed in the fixed income market since the last time we chatted.
It's nice to have you on. We have a slightly more normal period right now, bond market returns. You've got a little bit more yield to go after, even if volatility remains elevated. We could take a moment and reflect a little bit on that. 2022 was a very different point in time. You've been investing for a long time through many cycles. How does this period of bond market volatility and the hyper focus on rates compare to other times in your career?
Going back to early 2022 and what we've been living through over the last 3.5 years, I would say that it's probably been the most challenging 3.5 years that I can remember in my career, where you just had this constant situation where we've had all these flashpoints in the markets that have come really fast and furious. We had the hiking cycle in 22. It was then UK fiscal crisis with Liz Truss and the mini budget, Silicon Valley Bank in early 2023, yen carry trade unwind the summer of last year, and then this year, of course, with reciprocal tariffs and trade wars. And it just feels like it's fast and furious, and we've just been trying to navigate what's been a really tricky 3.5 years. It's not that we didn't have periods of stress and volatility in the past. Just to date myself, I started doing this in the early 2000s. GFC, European sovereign crisis, taper tantrums, COVID. But I think just the compression of everything that's happened, geopolitics as well with Russia invading Ukraine, Middle East, it's just felt like it's one thing after another. And it's created a lot of volatility. And a lot of that vol has been focused really in the rates market. And it's not that we haven't seen volatility in the riskier parts of our universe, credit, FX, equity vol, but it's mostly been concentrated in interest rates. Yes, it's been challenging, but I think what it also has done, though, is that it's created a lot of opportunities. And when we think about how we invest as a team, interest rates are a lever that we can use to generate alpha for investors. And so if you've had a differentiated view on inflation, say in early 2022, or from a geographic perspective in terms of the rate cutting cycle over the last 12 plus months, there have been ways to generate alpha in interest rates that really suits how we invest. And I would expect that to continue. I think we're going to be in a structurally higher volatility environment going forward. And so I think it creates risks, but also certainly opportunities for us.
Well, I think we're excited to dive into some of your views on rates and where they may go, currencies, which also have been a big topic of conversation this year. But starting off with just how you construct a portfolio. You run some portfolios that are pretty unconstrained in terms of what kind of interest rate risk you can take on, how much credit risk you want to take on, what kind of currency exposures you want. How do you approach building a bond portfolio like that with a totally blank sheet of paper? What informs where you're going to put your capital, where you're going to focus your research at the company and the macro level?
We invest portfolios really on an unconstrained basis, unconstrained in terms of asset class, unconstrained in terms of geography, all trying to find the best opportunities for risk-adjusted returns on behalf of our investors. And it has to start in global fixed income in terms of your assessment of where you are in the economic cycle. We spend a lot of time as a team looking at all the major developed economies, the major emerging economies. That tends to cover probably roughly about 80% of GDP. And plotting each one of those countries on the continuum of the economic cycle, from recovery through peak, slowdown into the trough, but also thinking holistically, where are we now in the global economic cycle? And then how can we think about levels of risk based on that view, composition of risk based on that view? And so that blank piece of paper, in a way, really allows us to think about in the context of trying to harness the asymmetry of fixed income returns. Certainly, there are markets where there's a lot of upside opportunities in fixed income when valuations are cheap, when you have a favorable macro environment with growth, easy monetary and fiscal policy. So taking advantage of high yield, emerging markets, but also thinking about the fact that fixed income is meant to be a stability asset. And so when you get late cycle where we think we are now, taking less risk in the portfolio, focusing on the more defensive parts of the fixed income universe, like interest rates, securitized, others. And so we really want to marry up both this top-down view with doing really differentiated fundamental research as well at the company level. You talked, Erika, about the information you're hearing from companies and managers. We spend a lot of time speaking to companies about topics like input costs, supply chains, CapEx spending, labor markets, which are obviously very topical now. And that helps to feed up into not just the security selection and sector selection, but also our macro views as well. I mean, so much of what we do as investors is trying to have a different view than what the market's pricing in. And I often think back to Wayne Gretzky's always talking about not skating where the puck is today, but where the puck is going. That information we get from the bottom up as a component of that macro assessment, I think allows us to position portfolios that are unconstrained to where we think the world is going to be and where the opportunity set is from a valuation perspective.
Maybe we could dive into the U.S. economy. You mentioned you think we're late cycle. We've talked about some of the confusing data points. We've got a rip-roaring AI-related market, but weakness in housing, industrial economies, slowing labor market. Where do you think we are? What's your near-term outlook? And do you feel like it's differentiated maybe from Wall Street proper?
It is a really interesting time to think about the U.S. economy because I think the way we might have talked about it 20 and 25 years ago is different from today. Back then, we would say, well, the U.S. economy is all about houses and cars. And now we're talking about it's a bifurcated economy in terms of AI and then everything else. And AI is now making up the majority of growth. It's not consumption anymore, or it's less consumption, it's more AI investment. That's very, very different to where we were just a couple of years ago. There's also bifurcation in the economy now that we're talking about in terms of the consumer. The high-end cohort of the consumer is making up the majority of spending in the US. And so it's actually quite a different way to think about the US economy to where we might have thought about it before. Our own personal view is that the US economy, while it has been, to your point, actually doing pretty well, is actually pretty fragile. That I think a lot of this growth is being predicated on a belief that AI is transformational, that you will get a return on your investment for all this CapEx spending in data centers, et cetera. And we have some worries that maybe it's going to underwhelm to some extent. But we also think that from a labor market perspective, that things aren't that rosy either. And one of the things we've hearing a lot from companies is that it's a much different story in terms of hiring than it was in early 2022. That was one of the things that was actually quite differentiated in our view was that in 22, central bankers pounding the table saying, look, inflation's transitory, nothing to see here. But companies were saying, we can't hire anybody. And if we do want to hire people, we're paying wages well above the market structure. And that to us was very much a traditional wage price spiral, where we thought inflation would be materially higher than what the market was pricing in. And if you thought about where rates were at that moment, basically at the lower bound, really could only go one way, and that was up. What we've heard from companies over the last 6 to 12 months is a much different story. We're asking our employees to work less hours, letting go of temporary workers. That leads traditionally more permanent job losses. And hearing that over the last 6 and 12 months and now seeing it really play out in the labor market data with pretty weak NFP numbers. We've seen the big revisions from the BLS as well. I think is consistent with our view. One of the reasons we've been increasing duration in portfolios over the last 6 to 12 months is because we have thought the labor market was probably weaker than the market was expecting. I think the other thing that concerns us about the U.S. economy, and you've talked about already, Sid, is that there is a circularity here between what's happening in AI and the consumer. The top decile of the consumer in the U.S. is making up the majority of the spend now, or almost 50% of spend. And that's really a byproduct of the fact that asset prices have gone up. They have become wealthier. They have a higher propensity to spend. And so if there is any slowdown or any underwhelming of this AI story and it impacts asset prices, then it can impact the consumer as well. And so, we're watching that very, very closely. It hasn't really spilled over in terms of investment opportunities per se in fixed income yet. It's been much more of an equity story, but it's something that we have to focus on significantly. And we are of the mind that it doesn't take much at this point to potentially cause a bit of a wobble in the U.S. economy. It could be an exogenous shock, the government shutdown that Erika has already mentioned. And so these are things that we're watching very closely. And we do think that the U.S. economy is probably biased to be slowing from here.
On the point of labor, I think a lot of AI bulls will talk about how we might see a softening of the labor market because of AI, because the tech companies are hiring fewer people or actually letting people go because they're using AI to do coding for them for 30, 50%. I talked to somebody last night who said in 3 years, 100% of code that is written for these tech companies is going to be done agentically with AI. Do you hear any of that from companies? I know it's mostly in the tech sector that we're hearing tip of the spear here. How do you think about that? And then also secondarily, with rates coming down, can that soften some of the blows economically and potentially provide a little bit of a boost to the economy? And more specifically, are you worried about a slowdown or are you worried about a recession in the next 12 to 24 months?
Just on the question about AI and implications for labor markets, it's tough to know right now how much AI is impacting the labor market. I would say that what seems apparent is that, to your point, that there are probably some places where AI will very, very quickly take job share, whether it's entry-level consulting jobs or coding jobs, even investment management. I think AI can probably solve a lot of the tasks that typically would have been done by entry-level employees. And I think actually we are seeing that in the macro data. So 2.5 years ago, unemployment rate was 3.4 and now it's 4.3. But if you look at some of the sub-cohorts, that 16 to 24-year-old demographic has gone from 6.6 to 10.5. And our guess is that a pretty decent amount of that's probably because AI is just disintermediating younger workers from the labor force. That's anecdotal, but that would be our best guess that AI is probably playing some role in that. I think going forward that we will see more and more jobs that will be shifted over to AI versus humans, both white collar jobs, probably manufacturing jobs as well. There is a marriage between robotics and AI that's happening. Probably China's leading it, but it will probably come over to the West as well. And we can imagine that at some point, manufacturing jobs will move to AI as well. And so this is longer form in nature. It's harder to see probably today, but it's certainly something that we're watching very closely and will have impacts in terms of just what the job market looks like in its construction going forward. One of the things that is coming, though, is a Fed cutting cycle. We've gotten a cut in September. We expect to see a few more this year. And so that can be a boost to the economy. Certainly some questions about, are they cutting and it stabilized the economy? Are they cutting because they have significant concerns about the overall health of the labor market? And it's actually something a little bit more sinister. And so that could be a deeper rate cutting cycle. And that's probably not great for the economy or for risk assets. And so there's a balancing act there. Our view in terms of is the U.S. going through recession or not, it's more been that the U.S. is slowing but will avoid recession. And we've had that view for a while. And to be fair, I mean, we thought the U.S. would slow much more in 2024, which didn't happen. And it would be more of a now 25, 26 story. I think we have seen some slowing in the U.S. economy. I think what we're really asking, though, and the question that is front and center for us is what type of growth slowdown leads to an impact on asset prices? Just going back to that potential for this negative feedback loop between asset prices and consumption. I mean, I think to us, that is really the big question. It's not just an equity market question either. I mean, it's also a question of looking at credit markets in fixed income. That's also a market that's been pretty exuberant. And I think a lot of that's been predicated on this general assumption that growth is going to be pretty firm and continue going forward. And so I think for us, recession, is it a possibility? It is, but it's not our central scenario. Our central scenario is that the U.S. economy will continue to slow, probably look a lot more like the rest of the world. They've already gone into a significant slowdown. So those will probably come and start to meet each other. But that slowdown will probably have a pass-through to asset prices, which has the risk, of course, of feeding back on itself.
Ryan, maybe we can drill into that a little bit more on whether or not we avoid a recession. Are you starting to see weakness on consumer spending? I know we've seen some data points come out of consumer confidence moving lower, but that does play into slowing GDP, which first quarter was negative. Second quarter, we had a nice balance of net exports, but first half has been slowing substantially. And as we look to the back half, the street and other data sources are pretty optimistic for a recovery in GDP growth.
I think when we spend time talking about the consumer, and this has been a big thematic we've been putting a lot of man hours towards, is there is this K-shaped recovery in the consumer. You have the top decile doing really well, and then everyone else not doing really well at all. And at the company level, what we're hearing is that, one, that spending is decreasing. The types of spending is changing. So instead of buying name brands, you go to the supermarket, you buy store label brands. So that basket composition is changing as well. And so I think there is definitely this optimism in terms of the consumer that the street is putting out there in terms of growth that we don't necessarily share. I think that it is really dictated now by the top end of earners, whilst the bottom end is really struggling. I think whether it's maxing out on credit cards, student loan debt, savings, all those things go into the mix. And to your point about consumer confidence as well. I mean, we've also seen a lot of those metrics turnover in a number of different data sets that we look at. And so I think overall, when we spend time thinking about the consumer in aggregate, we would argue that things are slowing. We have concerns about the health of the consumer at the bottom end, especially. And that tail risk is much more on the upper end of earners in the context of asset prices and the potential spillover. The other thing that to Sid's question about rates coming lower, and there's this sort of perverse negative impact from rates going lower, is that a lot of investors, especially if you have assets, have been in money markets, getting paid 5%, 4.5% of income into your savings accounts. And a lot of that ends up as discretionary spend. And so as rates come down, that income decreases. And that also has an impact in terms of the discretionary spend that's going out from higher end consumers. And so in a strange way, yes, Fed cuts typically are good, but it also could have a negative impact on spending from the top end of earners in the US.
And then drilling into labor, do you think we'll see a 5% unemployment rate?
That's the million-dollar question is, how high can the unemployment rate go? We think it's going higher for sure. I think a lot of the trend and labor metrics that we follow are weakening. Job openings are decreasing. Churn in the labor market is declining. So companies are less apt to hire, individuals less likely to leave their jobs. And what's historically correlated really well to the unemployment rate is the question within some of these surveys of whether jobs are plentiful or hard to get. And that metric also continues to deteriorate. So we do think unemployment is going to continue to move higher. What's the final resting place is very difficult to suss out. I think there are some implications from the government shutdown that we're currently going through that could have a negative impact on the unemployment rate. And so this has been, again, a view that we've had that has not necessarily been shared by the market or by the street, that unemployment would be ticking up probably quicker than people anticipated. That's really been underpinning our view on duration and on Fed cuts coming, and probably more sharply and deeper than the market's pricing in. And so we do think that can continue. I think one of the bigger changes that's happened recently has been a byproduct of immigration policy too. And that's for us challenging because you're having to recalibrate like what the break-even rate of job growth is in the US. For a long time, the high end of that range would be 250,000 jobs. And now maybe it's 50,000 jobs. So it's going to take some time to really understand what that number should be and to try to really understand the health of the labor market in the US. But I think all the indications that we're looking at is that job growth is going to be pretty close to zero or even negative. And the other thing that's been a component of job growth in the US is that it's been almost completely concentrated in two parts of the economy. It's been healthcare and it's been governmental jobs. And so one of the sticking points in this government shutdown, and it's anyone's guess in terms of when it ends, because both sides seem to be pretty stuck in and set in their views and both think that they have leverage in this negotiation, is that furloughed government workers may not get their jobs back. And that's also something that needs to be on people's minds in the context of the overall health of the labor market in the US.
Ryan, sticking on that, you've mentioned the government shutdown a few times, and hopefully it's sorted out soon. Is there anything else that we should be thinking about as far as impacts the longer this goes on?
Well, I think the first impact, as I mentioned, is on these government jobs. And do they come back or do they not come back? And that's anyone's guess. It seems like they probably won't come back. I'm not sure if that's a good policy stance or not from the administration, but it feels like that's what they'd like to accomplish. It actually is probably pretty consistent with the Doge experience that we had in the beginning of the year. So I think we need to take it as read, perhaps, that this is going to happen. And I think the conventional wisdom would be that every week that you have a government shutdown, it can impact GDP by 0.1 to 0.2%. And typically you would expect to get that back. And we don't have any reason to dispute that, frankly. But I think what it does do is that it does have the potential to impact consumer confidence even more. And in an economy, as I mentioned, that we think is pretty fragile, that's a concern to us. That, yes, you'll probably get the payback from this shutdown, but it could have some ramifications in terms of overall confidence at the consumer level. It's an economy that may or may not be able to weather that as a byproduct.
What are your views on inflation today? Markets long-term are pricing in 2.25% over the next 10 years. You taking the over or the under on that?
We actually think it's pretty fairly priced. We certainly have lived through a period of structurally higher inflation for a couple of years, and that was pretty tough. The disinflationary trend in the US and other parts of the world, especially the UK, has been pretty slow. But there are a lot of factors out there, in our view, that suggest that that number is probably not that far from reality. And one of the things with the trade war that we're dealing with is this question of what do tariffs mean for inflation? We would subscribe to the view that tariffs are probably a one-time shock to the price level, but the jury is still out. We don't know. But even if they are slightly higher than people might expect, that there are a lot of other factors that I think will overwhelm any inflation that you could get from the goods side. And especially on the housing side. Housing in the US, which is quite different to other inflation baskets around the world, makes up roughly 40% of the core CPI basket. And all the metrics that we look at, public and private, suggest that rents will continue to come down. So that will act as a disinflationary force to offset any inflation that we see from tariffs. Also, you look at some of the components of the JOLT survey, quits rates, job openings. We think wages will continue to come down as well, which should put downward pressure on inflation. If we see a loosening in the labor market, that can also act as a disinflationary pressure. And what we've also seen is that energy prices are coming down. And so at least on the headline level, we think that inflation can continue to stay pretty well anchored. It's hard to tell what the final resting place is, but as we look out on the forward curve for inflation, we don't think 2.25 is miles away from probably where it will sit on over a long-term basis.
Sticking with these fun point estimates, the market's assuming that rates are going to get cut and settle at just under 3%. Curious what your views are there, and then your view for where longer-term 10-year U.S. Treasury yield should be given your outlook. It sounds like you're in the camp of thinking we may get more cuts, and maybe that has an implication also for where you think long-term rates will settle out. But what are your thoughts?
Yeah, I think on the Fed, we certainly believe that the Fed will cut 2 more times this year. And then the question is, where does terminal shake out? Our view, as I mentioned, that we think that disinflation will continue into next year, that you have this loosening of the labor market, that actually terminal probably will be below 2.9, that it probably settles into the 2.5 range, which is obviously a different view than what the market is pricing in. And then there's the question that you just raised, which is, well, what does that mean for longer dated yields in the US? And it's very difficult to put a value on where a 10-year Treasury or 30-year Treasury should trade. There are a lot of assumptions that go into that, growth assumptions, terminal rate assumption, and then trying to come up with a number for term premium, which I would say outside of the R-star is probably the most finger in the air guesstimate number that we have in fixed income. Our view is that if the terminal rate ends up at around 2.5, and if the 2s10s curve ends up around 150, which is not miles away from long-term averages, that 4% on a 10-year Treasury feels about right to us.
And we're there today. We made it.
And we're there today. Yeah, absolutely. And then if you bake in another 75 basis points for 10s, 30s, that's 4.75 in the 30. We're inside of that now. And so to some extent, it feels like there's pretty fairly valued. When we think about our strategies and how we're positioning in duration now, one, we think the value in US Treasuries is very much concentrated on the front end. So 2 years out to the belly right now, those are the points in the curve that are the most sensitive to monetary policy. It's easier to have a view on that than what term premia is worth, frankly, over the long term. But we do have exposure to some longer data maturities in the US, 10s and 30s, because it provides some option value. If the US economy slows a lot quicker than people think, the job market loosens much more quickly and the Fed is forced into much more aggressive cutting cycle because we're heading into recession, the front end might outperform, but 10s and 30s will still do perfectly fine. And so we'd like to have some exposure on that end, but we'd still rather prefer having exposure on the front end where I think it's much more clear in terms of that trade-off, in terms of where rates will go. We think it's lower and much more sensitive to monetary policy.
Maybe you could talk a little bit about the spread environment. Spreads for investment-grade corporates are lower than historical averages. Securitized seem to be presenting a pretty decent opportunity, although spreads are tightening there as well. How are you thinking about both those areas of the bond market, and how are you positioned?
I'll make a categorical statement. Credit is very, very expensive. I think any way you slice and dice it, just on long-term historical averages, IG, high yield, it's really rich. So when we look at credit as an asset class, we're really focused on staying away from just the beta component or just the carry component and focusing much more on idiosyncratic opportunities within companies, upgrading the credit quality of the businesses that we own. So specific sectors, typically anti-cyclical type of business models, less exposure to the consumer. That's what's really factoring into our security selection here. I think we talk a lot about asymmetry in fixed income. And if you look at where spreads are now in IG and high yield, there's very little upside case to be made for spreads going materially tighter from here. Could they go tighter? They could, but there's a limited amount of how much tightening can come. On the other hand, we saw it in April. We actually saw it this past Friday. There is significant widening risk in credit if we go into some sort of adverse economic scenario. And so we'd much rather be focused on specific business models, specific sectors, but also leaving ourselves a lot of dry powder to be reallocating back into credit when we see it at levels that are a lot more attractive, where we're actually getting paid for the risk that we are taking. We know that if we're buying IG companies at 150 to 200 basis points over treasuries, or buying high yield companies at 5, 6, 700 basis points over treasuries, that our absolute and excess returns over the next 12 and 24 months will be extremely attractive on behalf of our investors. If you're buying credit at these levels, you can look at it historically, excess returns over the next 12 and 24 months are typically negative. And that's actually not a great trade-off for us. And so we don't have a lot of credit in strategies. We're just kind of picking our spots. But on the securitized side, you're right. I mean, securitized has looked really attractive if you compare it apples to apples to corporate credit. You can go into higher quality types of investments like agency MBS and pick up excess spread and actually upgrade the credit quality of your portfolio. And so we've been doing that in terms of the asset allocation mix in the portfolio, less in terms of a traditional corporate credit, more into securitized, but that has started to tighten as well. And so that creates a bit of a challenge. I think one of the nice things about securitized is that it offers less duration risk. There's a quality bias to it, which is great. I think it's beneficial in these types of environments. But there are other parts of the securitized space on the credit side that actually look interesting as well. Prime auto ABS, we think is interesting. Equipment-backed ABS is interesting. But there's definitely some stress in the subprime sector. So staying high quality within the more credit-orientated spaces within securitized, we think makes a lot of sense. And the other elephant in the room in securitized, which it's anyone's guess, is the privatization question on the GSEs. It could be very unpredictable. And so I think it's something that we need to watch pretty closely. We don't know what the probability is. It's probably a low probability that something happens that's particularly adverse, but we need to keep it on the front burner as we think about the asset class.
Ryan, overall, U.S. high yield has done very well this year from a performance standpoint, and a lot of that is the carry, but spreads are really tight. How do you make sense of that?
You mentioned FOMO in the lead. I'd argue that there's a FOMO component as well to high yield investing. People, I think, very much are focused in terms of all-in yields, despite a lot of that yield coming from the treasury component. If you're getting paid 7.5%, 8% to own a high yield bond, people think it's actually pretty good. But it also assumes growth holding up, that the market environment stays pretty benign, that volatility stays low. Those are not necessarily things that we believe, but I think that's what's underpinning the high yield market. But when you start looking at things like default rates, I mean, default rates are picking up. We've had 2 high-profile defaults just in the last couple of weeks with Tricolor and with First Brands. There have been a lot of other ones that have been happening in the background that don't get as much press and you don't make it to the front page of the Journal or the FT. But we have default rates now sitting in the mid-5s. They're not in the 3s anymore. And so, when we think about trying to ascribe a value number in terms of where high yield should trade, thinking about default rates, thinking about recovery rates, and some excess spread on top of that, our view is that high yield is probably about 200 basis points too tight, all things considered. So it's the same mindset when we think about high yield that we think about just IG in general or credit in general, is pick your spots, invest in good companies where you have pretty high level of confidence in terms of the business model, but also where you're getting paid a fair amount of risk premium to take on that risk. But I think it's all sort of part and parcel with the market environment that we're in. FOMO and equities in credit, people are going much more into private credit, into crypto. It's frothy, it's late cycle, and our markets are not immune from that.
Ryan, moving overseas, the big rate moves are not just a U.S. story. We've seen UK, Europe, and Japan experience pretty big moves higher, specifically at the long end of the curve, mostly on inflation, expanding budgets. Are you seeing more opportunities outside the U.S.?
This is a topic that's near and dear to my heart. Being based in London, I spend a lot of my time thinking about the world outside the US. And a lot of countries are facing the same issues that the US is facing, which is just swelling debt levels. Inflation is sticky in places like the UK. We've had political changes that have challenged that. It's France, it's Japan, UK, US, others. And so that move in 30s that you mentioned has been happening basically around the world. And so that's created some challenges for investors in trying to pick your spots. One of the things that we found very interesting coming into this year, and I think was heightened by the reciprocal tariffs and the trade war, was asking the question about these different geographies where we could allocate duration risk. What does trade war mean for each of these countries individually? And what was very clear to us was that the trade war meant a different thing to the US economy than, say, Canada, Eurozone, UK, Australia, New Zealand. In the US, it is a trade-off between both growth and inflation, but everywhere else, it's a growth story. And so we've had the view throughout the course of this year that central banks outside the US would be cutting rates ahead of the Fed, which is actually pretty rare. Typically in cutting cycles, the Fed goes first and everyone follows the Fed. In this case, everyone has been ahead of the Fed, basically. The ECB is already at or very, very close to terminal. The RBNZ, the same story, Bank of Canada, et cetera. And so we have had actually at the beginning of the year been moving a lot of our duration risk outside the US into other parts of the world where we felt like we were being compensated pretty well for the beginning of a cutting cycle. We've gotten towards the end of those cutting cycles as the year has gone on. And so where we're seeing value now is actually going back into the US, going into the UK, where we think the Bank of England will be cutting rates as the labor market loosens, as wages come down, as the disinflation momentum is picking up steam. And so I think that flexibility and that unconstrained mandate that we have allows us to be opportunistic in terms of where we're allocating duration around the world. But the question, that Sid asked, what is value in terms of the long dated maturity of a 10-year treasury or 30-year treasury? It's the same question we're asking in terms of a 30-year gilt or a 30-year JGB. Like, what is fair value? It's very difficult to figure that out. A lot of it's being driven by supply and demand with regulatory changes in terms of Dutch pension funds. Japan's the same story. And so we still think value in global fixed income, ex-US, is still very much in the front end of yield curves. Where we're really taking advantage of is just good old-fashioned bond math. Sid, you mentioned that yields are higher. So you get the income from owning duration in the 5 to 7 year point in the curve, but just as those bonds roll down the curve, you get paid as well. And so we think the total returns are pretty attractive to move out from twos into the belly now, in different parts of the world. We still think rate cuts are coming, especially in New Zealand, in the UK, and the US, but we've been doing a lot more optimizing in terms of that geographic split over the last 3 months or so.
Ryan, sticking on international for a minute, with the US dollar weakness this year, we're getting a lot of questions about the impacts of currency as well as emerging market debt. How do you think about both of those?
Just to focus on the EM question first, EM has done really, really well. And a lot of that has been because the dollar has come off. I think there's been a big flow of money outside of DM into EM, whether it's in local rates, whether it's in EM credit. Our view on EM is slightly more nuanced in the sense that if we have a view that we are in the late cycle stage of the global economy, that we also have to be thoughtful about where we're taking risk in EM. So we are finding opportunities, EM corporate names in countries like India, Brazil, Mexico. We do have some exposure in EM in the sovereign space in Brazil, for example. But EM itself, it's a risk asset. So if we did see a big shock to the equity markets in the US, for example, it will spill over to EM assets as well. And so we're not putting a lot of our risk into EM, but we do recognize that there are pockets of opportunity in that space. I would say too, just looking at EM corporate spreads in general, they're also rich. They look like they're cheap just at the outright level, but if you compare them to where DM spreads are on a longer term basis, they actually are pretty rich as well. So I think we also just need to focus on trying to eliminate the beta component of that exposure and just focus much more on those idiosyncratic opportunities where we are finding opportunities. And they're out there, whether it's in banks, in some consumer companies. We're finding renewable energy companies in India that are very interesting and undercovered. And so we are picking our spots. But the big elephant in the room is the US dollar. And that has been quite a significant shift from the world that we had lived in from 2022 to the beginning of this year. And really, obviously, the trade war story was the big catalyst for this big move down in the US dollar this year. I've had the really good fortune of spending a lot of time overseas, meeting with our investors, prospects in Asia, around Europe, Middle East. And there has been one consistent theme, which is overseas investors have all said, look, we have made a lot of money in the US over the last 3-4 years in the US equity markets. Almost all that has been on an unhedged basis. And we are concerned. We're concerned about policy in the US. We're concerned about the fact that we are over-allocated on a geographic basis to the US. And so we'd really like to get closer to home. So some of that is selling US assets. We haven't seen a lot of that flow just yet, but what we are seeing is a lot of hedging flow. And if you look at Canada, Australia, Japan, I mean, their overall hedging ratios right now are so much lower than the long-term averages that the magnitude of that flow is really, really substantial. There was an interesting study, I think it was UBS that did it, and they came up with a number. It's almost something like 14 or 15 trillion of unhedged overseas investment into the US equities, fixed income. And you don't need to see a lot of that go out the door and being hedged back to home currencies for that to have a significant impact on the US dollar. In our view, this is early innings. This is the beginning of a repricing of the US dollar. I mean, the US dollar, even down 7-8% this year, is still very, very expensive on a number of different metrics. And so our expectation is that it's not going to be a straight line. These things never are. They're going to chop around, but that as this hedging flow happens, as the Fed cuts rates, as we expect, that this will pick up steam. And it also has some circularity. As the dollar goes down, people want to hedge more. As people hedge more, the dollar goes down. And so we think that this can be a pretty substantial move and something that actually we've been taking advantage of in our portfolio. We've had a structural dollar short for the majority of this year against a basket of currencies, Brazil, Canada, Australia, Japan, Euro. And that's done really well. It's been volatile, but we think it's just something that we can monetize over the long term.
Sticking with the dollar, how do you think about the longer term question that we get asked a lot about the dollar as the reserve currency? We're certainly seeing some central banks moving from dollars and other hard currencies to gold this year, as an example. And we've seen an unbelievable move, biggest in 50 years. But if you look out longer term, 5-10 years, do you see a substantial threat to the dollar in any meaningful way?
It is a big question. I think that calling the demise of the US dollar as the world's reserve currency is probably a bit premature, frankly. I think the bigger question is what is the right share of a reserve basket to the US dollar? It's been over allocated to dollars. And so I think you've seen people sell dollars to move into gold, for example. There are other parts of the world that are looking at this as an opportunity set. And we've heard Christine Lagarde talk about it over and over again, that this is a moment for Europe to take some market share from the US in the context of being a reserve currency. And she's like, look, we have an independent central bank. We have the rule of law. We have a bond market that is becoming deeper and deeper all the time because we're having a lot more issuance from, say, Germany. Germany's doing €1 trillion of issuance over the next 10 years. So is it a one-for-one substitute for the US Treasury market as a reserve currency? Well, the answer is no, but certainly the share could increase. Longer term, I don't know the answer. I don't think anyone does. Everyone's like, well, maybe it'll be the Chinese yuan. I think it's probably pretty unlikely. Does the euro take over for the dollar? Probably not. But I think it's more the composition of those baskets. And as you point out, I think this move in gold is symptomatic of that as people look at the US with a little bit more sensitivity around some of the uncertainty and look at ways to diversify their holdings.
Maybe I could jump back to the AI question. I feel like I didn't ask you and wanted to ask you about the growing impact of AI in the bond market. We've certainly seen a lot of statistics about what percentage of the bond market is kind of linked to AI. I mentioned the $100 billion of data center debt or thereabouts that exists. Are you seeing a greater impact, and do you feel like we could be setting ourselves up for any systemic bond market risk related to the AI build-out?
Up until the last few quarters, this AI investment story has been all equity and free cash flow funded. And it's just now recently, to your point, that it is starting to become much more of a bond story. Before, we were pretty comfortable with it because it really wasn't a leverage issue. But now we're talking about all sorts of issuance in the bond market, in the IG market, securitized issuance in the ABS market, and private credit is obviously really leaning into AI. So I think now what we're really focused on is what's the ROI on these investments? You're going to need free cash flow to pay these bonds back. So I think it does start to inject the potential for some sort of systemic risk to bond markets. I think it's probably less so on the public side. I think probably where we are a little bit more concerned is on the private side, just with how opaque those markets are. You mentioned as well the circularity of the AI story right now. That feels very late cycle behavior to us and very convoluted, where everyone's funding each other. So we have some questions about that as well. And so it's something that we are watching pretty closely. And now it is becoming much more of a bond market story. That being said, though, there are opportunities in fixed income to play this. We're owning companies like Ferguson and Carrier today that are cyclical that we typically wouldn't own at this point in the economic cycle, but have some attractive tailwinds because of the AI build out. And so that's actually pretty interesting for us. REITs that are tied to the growth of data centers. Those are pretty interesting ways for us to play this story in good fundamental companies that we think we can monetize. But that's a separate story to the more potential systematic question that you're asking. Look, we are bond investors. We think a lot about downside risk. That's just how we're wired. That's our asset class, frankly, given our limited upside, and downside can be zero. And so we spend a lot of time thinking about the negative implications, but we shouldn't put to the side that there are opportunities that are arising from that we can take advantage of in our portfolios.
Ryan, you mentioned private credit. What's your opinion on the large amount of capital that's flowing into funds right now and the overall opportunity in the space?
It's remarkable, isn't it? Just how much money is flowing into private credit. One of the other things I heard a lot on my travels is just how much of an investment asset allocators are making into private credit. Some of it seems very well thought out. To some of the investment, just more broadly, is concerning because a lot of it is focused just on the yield component. I know that you guys look a lot at private credit, and a lot of how we do underwriting at the firm is focused on the managers that we work with. I think in the underwriting standards and the type of businesses that they own, I think that is really, really important because you don't have great line of sight into what companies own per se. And I do worry that to some extent, like in any market, when money is flowing in, it needs to be put to work. And so underwriting standards can be somewhat lax. I think the regulatory environment in private credit suggests that we could have some lax underwriting standards. And we're already seeing it with, again, First Brands and others, where it is going to hit the private credit market. So it is probably a little bit of a two-sided coin here. I think there are definitely opportunities in private credit with good managers to really provide uncorrelated types of returns to other assets that one owns in portfolios. I think that's really important. I think there will probably be some other managers where it probably isn't so benign. And I think just as an asset class in general, our bigger concern on private credit is probably that a smaller manager has a blow up and then people start questioning the asset class itself, and liquidity is different than in public markets. And the way it passes through to us as public market investors is that we don't think that these things are separate. If you have issues in the private credit market, it will spill over to the public markets. And we've been talking about that for a long time. And the other thing that we would say as well is that the economic slowdown that we've been talking about, if it was to come to pass, we've seen some pretty interesting studies about the qualities of businesses that are owned within these types of business models. And if you're in a lightly stressed or stressed environment, a lot of these portfolio companies go free cash flow negative. And that is concerning to us. And so you said in the beginning, Erika, all these things are intertwined. And a lot of it is predicated on that growth outlook. But certainly the private credit markets are going to be very sensitive to that. And so I think it's something that we are certainly keeping our eyes on very closely.
Maybe we could close it out, Ryan, with a bit of a softball, I guess. I mean, depending on your answer. But valuations in a lot of asset classes appear above long-term historical averages. I mean, you talked about spreads in corporate credit, tight, high yield tight, but is this a good time to be invested in global bond strategies? How do you think about it?
It is a softball question, so thank you for that. But I would say it is a good time. I think what we have seen, though, is there are two questions to ask. One is global versus US, and the second is active versus passive. And the argument that we would make is the world that we're living in today is a new market paradigm. It's a different market paradigm, certainly to the world that we lived in post the GFC, where volatility was very, very low, and every country was cutting rates at the same time, and yields went down and spreads went down, and there's very little dispersion in terms of economic outcomes. This is a world where if you look around the globe, you have a lot of different countries in different parts of the economic cycle. You have monetary policy in different parts of their cycle. And so fiscal policy, the same story. And so global investing in fixed income allows you to allocate risk to the parts of the world where there are significant opportunities, as opposed to being sort of singularly focused on just one market. I think what we have seen over the last 3.5 years is that there are alpha opportunities for us in interest rates, in credit, in currencies that are really the purview of global mandates that we can take advantage of. And so I think it's a really interesting time. And on the active versus passive side, I think what's really important and has really hit everyone's minds in 2022 is that passive investing in fixed income has a lot of embedded risk. The global aggregate benchmark, the US aggregate benchmark has 6.5 or 6 years of duration, respectively. And if interest rates can go higher, and they will go higher, because we're now back to a world where it's all about cycles again, very much like the world that existed pre the GFC, that being active in terms of how you take risk and where you take risk is going to be able to deliver a significant amount of alpha for your investors as opposed to be passively allocated to the asset class. And what we've seen historically is that, maybe slightly differently to equity markets, is that there's a lot more alpha generation and consistent alpha generation versus benchmarks in global fixed income than there is in equities. And so I think people are coming around to the view that after 2022 and being hit pretty hard in terms of that passive allocation to fixed income, that all of a sudden that active strategies make sense again. And with all the things that are out there in the US with the US dollar, that a lot of different countries' currency exposures have some significant return opportunities that aren't on offer if you're just focused on one marketplace, whether it's the UK or the US. And so we're really excited about what the world has in store for us. It won't be easy. I would expect it to look a lot like the last 3 years. But again, with that creates a lot of opportunities, which we're excited to take advantage of on behalf of our clients.
Ryan, that was great. Thank you so much for joining us today. Really appreciate your time. Great to have you back on. Hopefully it won't be 3 years until the next time.
I'm glad you guys reached out. Always happy to do it. Thanks for having me.